All right, let's dive right into this because today we're unpacking a truly fascinating collision of two worlds that are usually seen as mortal enemies: decentralized digital currency and centralized national government debt. You know, crypto's original promise was all about escaping the system, right? That was the decentralized ethos that drew so many early adopters in. This idea of a financial ecosystem completely detached from government control and monetary inflation. Section 1. The digital bailout. A hidden financial rescue operation. Brian, the CPA whose analysis we're breaking down today, states this pretty bluntly. He says most people think crypto is about escaping the system, but the government just turned it into a massive bailout. He's arguing here that stablecoins have been utilized as a secret tool for the US Treasury. I mean, this is an incredibly impactful claim because it fundamentally flips the script on what large-scale crypto adoption actually means for legacy financial systems. So we're going to impartially map out exactly how he claims this is happening, so you can see the math for yourself. Section 2. Exposing the math. The hidden legislative mechanics. Okay, so what is the Genius Act? Basically, it's a mandate requiring every stablecoin to be fully backed by United States Treasury bills. What this legislation does is legally dictate exactly what sits in the reserve vaults to give these digital assets their peg. By mandating that those reserves must be US Treasury bills, the legislation fundamentally intertwines the crypto market with the national debt. And when you think about the scale at which major stablecoin issuers operate today, we're talking managing tens of billions of dollars in daily volume. This isn't just a minor regulatory tweak. It essentially turns the largest crypto reserves into massive, captive buyers of government debt. Let's actually trace a single digital dollar from your wallet straight into government coffers, just to see how this capital movement actually flows. Step 1. An investor buys a stablecoin, thinking they're just parking their capital in a stable digital asset. But because of the Genius Act, Step 2 kicks in. The entity issuing that stablecoin is mandated to take that real dollar and buy a US Treasury bill to back it, which leads us to Step 3. Immediately, the US Treasury receives that money as a low-interest loan. So the absolutely crucial point here is that without the investor ever actively choosing to buy government debt, their participation in the stablecoin market automatically funds the Treasury. Moving on to Section 3, the 11 trillion cycle, driving force demand. $11 trillion. Let that sink in for a second. According to Brian's analysis, that is the staggering debt cycle the US government is managing right now. When a sovereign entity has a debt burden that astronomical, finding willing buyers for that debt isn't just routine finance anymore. It literally becomes a matter of national financial survival. The liquidity issues associated with constantly rolling over an $11 trillion deficit are severe. The analysis argues that the stablecoin legislation isn't primarily about regulating crypto for consumer protection. No, it's about actively generating a massive forced demand to feed this exact debt cycle and maintain government liquidity. And by doing this, they're keeping interest rates artificially low, which helps the government avoid a crisis. So, here's the macroeconomic supply and demand math according to the source. When the government needs to borrow money, it issues treasury bills. In a normal free market, if organic demand for those bills drops, the government has to offer a higher, more attractive interest rate to entice buyers, right? But by using the Genius Act to mandate that stablecoin issuers absolutely must buy T-bills, the government effectively creates a massive captive market. Because there's this constant legislatively forced demand coming directly from the crypto sector, the Treasury doesn't have to raise rates to attract buyers. They can successfully prevent their interest rates from exploding just by tapping into crypto liquidity. It's wild. Which brings us to Section 4, shielding the system. So the dual effects of the Genius Act are actually pretty profound. First, it creates that forced demand for US T-bills. Second, this artificially lowers the government's overall interest bill. But honestly, it's the third point that is the real kicker here. It shields government overspending habits. Brian's analysis suggests that when you hold these assets, your crypto is functionally acting as the ultimate shield for the government. By providing them with an endless stream of low-interest loans via this mandate, the government completely avoids the natural free market consequences of overspending. They're effectively stalling a potential devastating debt crisis by balancing it right on the backs of digital dollar holders. The source material wraps up with a very specific call to action. Avoid the economic theater. Brian urges investors not to be victims of a system they don't fundamentally understand. His advice is to learn the rules of this new financial landscape so you can keep the math in your favor. And keeping the math in your favor, based on his logic, means recognizing exactly when your liquidity is being utilized to subsidize institutional debt, and positioning yourself accordingly rather than just being an unwitting participant. He suggests that for those who want to stay ahead of this financial siphon, you should subscribe to his platform, Hidden Tax, to keep track of these hidden economic mechanics. So, we have to ask, are your digital dollars funding the system you tried to escape? We started this explainer by looking at the decentralized promise of cryptocurrency, but as the math behind the Genius Act shows, the reality of how stablecoins are backed paints a very different picture of where that capital ultimately flows. It definitely leaves you wanting to look a little closer at the true nature of your digital wallet, doesn't it? Keep asking the right questions.